Upasana Taku joining in, Executive Director and Chairperson and CFO at MobiKwik Systems. Upasana, always a pleasure to speak with you as always. Let's go through the quarter. It was a bit of a muted quarter. What do you think are the key reasons for this?
So firstly, good morning and thank you for having me on your show. Actually, I would like to say that it is not a muted quarter because see, last couple of quarters, we've already been presenting our numbers and explaining that Q3, Q4 of the last financial year, while we've done amazingly on the core payments business, on the financial services side, given the headwinds in the sector with regard to unsecured lending, we've not been able to distribute enough loans. So therefore, the performance in Q3, Q4 on the financial services side has been weak. Now, the right way to analyze the business is to see that, okay, now are they recovering? And I think that is what I would like to highlight, that Q1 has been an amazing quarter from demonstrating resilience as well as recovery. Payments business has again given amazing growth, very high GMV growth, the best contribution margin of any payments company in India. We are clocking at 15 net basis points in terms of payments margin, which is 4 or 5x of our close competitors. Now, on the financial services side, also, if you will see, disbursals have gone up. This quarter, we have done about 31% disbursal growth in the ZIP EMI personal loan product that we have. Last quarter, we had demonstrated 32% disbursal growth. Along with that, gross margin also has improved in financial services, resulting in the fact that overall contribution margin for the company has improved this quarter, and the losses have also come off. Very simply put, last quarter we were at about negative 45 crores in EBITDA, and this quarter we are negative 31 crores. So we have made a big difference and covered almost 15 crores in one quarter. By that logic, if we continue to do similarly for the next 2 quarters, then we should be profitable in 2 quarters. Even if we are not able to do 15 crore every quarter, then we should still be able to recover, in the last quarter of this year. So I think that is the right way to look at it, because we've already informed that last year Q1, Q2 were our best quarters, and the downturn in lending only started in Q3, Q4. So any comparisons to Q1 last year is obviously going to show abysmal results. The right way to look at it is how much have they recovered from previous quarter.
Okay, fair, which is why we want to know your point of view. Just can you focus a bit on the target that you've talked about, the goal you've talked about of turning EBITDA positive in the next 2 quarters? How do you see that happening? Are you seeing the financial services growth that you've talked about improving at this click?
No, absolutely. So financial services, GMV or disbursal is growing.
Yeah.
The margins are growing. And also we have informed in our various quarterly releases that there was also a contractual change that happened last year, due to which currently, we are booking more cost upfront and the revenue is backloaded on these 12-month loans. These are all the reasons due to which post August or post September, we expect to see normalized results in our financial services business. So the business has not still fully recovered. The gross margin of the financial services distribution business is typically 30 to 40%. This quarter also, we have improved it from previous quarter 4 to this quarter 13%. So we are expecting the margin to expand further on financial services, the disbursal and revenue also to grow. In addition, if you will see, this quarter, we have optimized all of our direct costs. In our payments business, the payment gateway costs and the user incentives are the main direct costs. And in financial services, lending related expenses are the direct costs. All of these costs have been optimized 5 to 6% quarter over quarter from Q4 to Q1. In addition, the fixed cost of the company continues to be held stable for the last 5 quarters. This quarter, we are at about 108 crores of fixed costs below contribution margin. And it has been in the same number, 104 to 108 crores in the last 5 quarters. So strong cost control discipline, while at the same time expanding both the payments business, which has of course been a fantastic growth. We have grown 53% year over year and 16% quarter over quarter in our core payments business. So on the back of all of this, we feel confident that in the second half of this year, we should be able to turn profitable.
Okay. I think Harsh, my colleague, was talking about how the customer acquisition costs handling a lot of businesses, including yours maybe, and whether the company has the levers to control that and a guidance on that. Any thoughts there, Upasana?
Yeah, no, absolutely. I think the cost of user acquisition has gone up very slightly, and it has more to do with the fact that we use a mix of platforms to acquire customers. This quarter, we have focused a lot more on the American-owned companies, namely Google, Meta, etc. And given the dollar rupee rate, there is a marginal increase in the CAC, so to speak. We will continuously work on optimizing the cost of user acquisition while maintaining the user growth rate also going forward. You will see that the company will diversify in terms of how we are acquiring customers from different channels. So I'm not too worried about it, because even with a 40 rupee customer acquisition cost, this is still perhaps the best CAC across the fintech sector in India.
But can you bring it down, is the question.
Yeah, we intend to keep it.
Year?
Keep it in that 30 to 40 rupee range itself.
Okay.
That is the sort of the goal.
No. Okay, fair call. But no definitive timelines about when it can come down substantially, I reckon. Not at this stage, at least, right?
Well, yeah, no definitive timeline for CAC per se, but for EBITDA, definitely I'm giving a timeline.
Yeah, perfect. Which was actually going to be the question, right? And you kind of answered it, that the EBITDA break even happens at a particular point of time, which is good to know. The other question that I think people would have in mind is that what about growth, if not going back to the heady levels that you had in the previous 2 quarters, which you said that then you guided that things will change. But I'm not talking about them going back to heady levels, but if I look at the next 2-year or 3-year period, do you believe you can show glimpses of that kind of growth rates anytime in the next 8 to 12 quarters?
No, absolutely. And if you look at our track record, if I look at the last 8-9 quarters, financial year 24, every quarter we were profitable. Financial year 25, first 2 quarters we were profitable. In both, or in all of those timelines, we were growing very nicely, between 40 to 50% growth rate we were delivering in terms of revenue. So this year, unfortunately for us, our first few quarters after listing, given the sentiment hit that unsecured lending took, have not been so amazing in terms of growth, just because of the macro being a problem. But this year will end up being a recovery year for us. And then we expect that we will be able to deliver similar growth rates, going profitable, as well as delivering strong growth year over year. I think for a fast growing company, fintech company, if you don't expect a 30 to 50% growth year over year, then what are the investors really looking for?
I'm wondering, Upasana, you talked about financial services, and let me come a bit to that. What is the kind of GMV you see next quarter on? Are you stabilizing at the 16% growth?
So financial services, the GMV has grown about 31% this quarter over last quarter. And last quarter, Q4, it grew about 32% over the previous quarter, Q3. So we are expecting it to grow in a similar nature. We are not providing any guidance in terms of the exact GMV numbers.